I'll introduce myself, John Lam, the Start Man. I know some of you have seen me before or know me. And I'm here to facilitate the session and ask any questions of David that come to mind. We also have Tiana here, who I will hand it off to introduce herself and introduce Edge.
My name is Tiana, and I'm the Business Development Support Specialist. And today I'm just behind the scenes helping up with any questions and tasks that we need to do. To start off, the session will be recorded. So if there's any problems with that, just private message me in the chat and we can do something about that. So what is Edge? Edge is a vibrant community of people from all backgrounds and walks of life who believe entrepreneurship can make lasting changing in society. We support change makers as they explore entrepreneurial approaches to create a more equitable and sustainable world. In collaboration with our partners, Edge provides new and growing ventures with mentorship, learning programs, and support to access funding. Edge is a gateway to Sheridan's innovation resources and offers physical and virtual communities where impact entrepreneurs can thrive. To start off, we're going to do a little land acknowledgement. We would like to acknowledge that the land on which we gather has been and still is the traditional territory of several indigenous nations, including the Anishinaabe, the Haudenosaunee Confederacy, the Wendat, the Métis, and the Mississauga of the First Nation. Since time immemorial, numerous indigenous nations and indigenous people have lived and passed through this territory. We recognize that this territory is covered by the Dish of One Spoon Treaty and the Two Brown Pot Treaty, which emphasizes the importance of joint stewardship, peace, and respectful relationship. Shannon affirms that it's our collective responsibility to honor and respect those who have gone before us, those who are here, and those who are yet to come. We are grateful for this opportunity to be working and living on this land. So a quick Zoom orientation. Please mute your mic if you're not speaking so we can eliminate any background noise. And also, webcams are not mandatory but are highly encouraged so we can have a more personable conversation and also see everyone's lovely faces. Again, the session will be recorded and any questions you can write in the chat box, which is at the bottom if you can see on the screen. For our agenda today, I have posted something in the chat that will help us know a little bit more about you, your venture, and what you want to learn from this session. And then we encourage you to say hello in the chat. And David is our special guest today, which he will do a presentation and will answer any questions that you guys have. So a little bit more about Edge. We strengthened the regional innovation ecosystem through collaboration and impact entrepreneurship expertise. We also provide inclusive support to impact entrepreneurs, offering mentorship, learning programs, co-working space, and funding. Lastly, we connect entrepreneurs to Sheridan's talent, expertise, and resources. We have several programs where we like to engage with our entrepreneurs in hopes to build their ventures. The 4 programs that we have are Explore, Leap, Rise, and Soar, where it starts from the ideation process all the way to your venture to scaling your venture and ensuring growth. Our mentor today is John. Like he said, he is the entrepreneurship lead for Edge's Brampton's Davis campus. He's also one of Edge's mentors that specializes with the ideation process of ventures, and he's here today to help facilitate the session. And we would like to give a warm welcome to our special guest, David Wright. He has spent his career supporting technology-enhanced high-growth companies as an equitable research analyst, investment banker, and corporate advisor. He is also the executive director of Angel One Network, where he curates the investment deal flow and supports members. David is here today to discuss what you need to know when applying for external investments for your venture. And also a fun fact, David actually taught his cat how to fetch. So that's interesting. I'd like to hand it off to you, David.
Well, thank you very much. Nice to be here presenting, and I hope this will be a useful session for you all. I think I'm going to share, I pulled together some slides, and no, it wasn't a COVID trick, is the question. I was doing my MBA actually, and I was studying, and we had a cat, and I was used to dogs, and I just got a little ball and threw the ball, and what you have to realize with cats is eventually they go and get the ball and bring it back to you. You just have to be patient and let them do it on their own time. And so that was fun. You can do that. So okay, I'm going to share my screen here. Yeah, continue. And I'm going to pull this up. So as I say, I pulled together some slides. It's when I'm presenting the slides, it's hard for me to see the chat. So feel free, John, to interrupt me in the discussion, because you're welcome to ask anything as we go through here. There's about, it's going to sound like a lot, about 35 slides, but I'm kind of going quickly through them. Because really I'm trying to hit about 9 different issues why you may not be getting funded from investors. And so this just collects my thoughts. And as I say, you're welcome to ask questions at any time. So let's see if I can figure out how to advance the slide. Okay. And there we go. Okay, so so as mentioned, I'm the executive director of Angel One. This is an angel group that was formed in 2011. Collectively, the members of Angel One over time, and those members generally come from Mississauga to Hamilton, have invested almost $30 million in 146 investments in 86 companies. Now, I started out at the beginning of the 1990s as an equity research analyst. And so for 20 years, I covered public software companies and IT services companies. So I saw companies like OpenText and Descartes and CGI go public, and watched as they acquired companies and grew, and all their various strategies. I then went on to do some private equity investing, or attempting to invest in Chinese companies. So I did a private equity stint back and forth to China. And then I formed a capital markets advisory business, where I've helped companies buy other companies and sell companies and access capital. I'm currently also an entrepreneur in residence at both Haltech and Innovation Factory. So there are a number of entrepreneur in residence there. Most of them are kind of for business planning purposes, marketing purposes. So they pull me in when it becomes a capital markets question. And I can use some of those stories today, or I will. So why you're not getting funded. Now, the other way you could word this is, it's not you, it's your market opportunity. So sometimes what happens is you don't define your market big enough. And I saw this actually just last week, where one of our clients has developed a new product, and it's going to be a consumer's product, and they expect that in the next 5 years they'll grow the business and be a $25 million business. And that's great, a good little business, but you're not going to get angel funding if all you're going to be is a $25 million business. I'm not really going to focus on the what motivates an angel, but one thing is that in angel investing, it's very risky. You're very likely that on a winning scenario, you don't get your money back for 6 to 10 years. And what will happen along the way is you will, a number of the companies that you've invested in have gone out of business. And so, you'll probably lose money on half your investments. So that means that the very few that are actually very successful need to be incredibly successful in order to average out the portfolio. So if all I do is invest in something that I'm only going to double my money on, well, that sounds great. It usually takes, as I say, 10 years to get your return. And so that needs to be, a 10 times return or bigger in order to kind of balance out all the things that haven't worked. Along with the market opportunity issue of size is also competition. Sometimes entrepreneurs come up with great ideas, but there's tons of competition. And like, hey, I'm going to open a coffee shop. Okay, good luck with that, because not only do you have to deal with the Starbucks, but you have to deal with any other person that it's easy to get into that business and they're going to compete. So how would I deal with that if I had to? Could you redefine your market? So one thing is, if the market's not big enough, you look at your product and can you sell ancillary services around it or ancillary products? So if it's let's say it's something like whatever, I just reached out and grabbed this speaker, but could you also sell headphones and chargers and, storage units and whatever along with it? So now the business is not just a single product, but it's multiple products, if that makes sense, that you can do that. So that's one way you might want to address it. It's not you, it's your industry. Angel groups will have specialties, and sometimes they just don't invest in certain areas. Our group just chose a few years ago not to invest in the cannabis space. So if you've got a cannabis idea, maybe it's a great idea, but we're just not going to do it. We don't invest in pharma either. And that's usually because, to develop a pharmaceutical product, it probably takes 10 years and $1 billion. And the risk is just too great for us. We don't have the scientific experience. Resources as well, we kind of leave for others that are experienced. And, it's easy to invest in real estate companies outside of our platform, so we don't need to be doing that. The other one is marketplaces, and marketplaces is a unique situation. So an example of a marketplace is, let's say you have homeowners and it's all the services around running a home, whether that's gardening services or painting or babysitting or anything like that. What you have to realize about marketplaces is you need to attract both the buyers and the sellers, so the suppliers and the consumers. And often when we ask questions of the entrepreneur about what's your cost of acquisition, they're often only focused on one side of that equation. Oh, in order to get a supplier, we spend $1,000 and this is what we get. Well, how'd you get the consumers? And the other aspect about marketplaces is you have to keep the buyers and sellers in balance even as you grow. So it's not good enough just to have 100 and 100, but 1,000 and 1,000, or 10,000 to 1,000, 100,000 to 10,000. You got to keep it in balance. The third issue is that often what happens is the buyers and the sellers will transact outside your marketplace. So in other words, you use the marketplace to hire the painter and he comes and paints one room, but then he says, I'll paint the rest of your house for free, or, outside of the marketplace, and you don't get paid. So how do you keep people on the platform? So what can you do about this? Well, first of all, every angel network is different. So, if it's not us, there might be other angel networks out there that invest in the area that you're interested in. And then the other thing is try to offset the risks. So for instance, in marketplaces, one strategy I've seen is the marketplace provides the supplier of services with insurance. So as long as you transact on our marketplace, you get insurance so that if you fall over and break your leg, then you get job insurance. So there are ways that you can look at your service and say, okay, if someone stays on the platform, then there's incentive to stay on that platform. It's not you, it's your revenues. So I mentioned this kind of as in the pharma example. And sometimes what we see is, an entrepreneur has come up with a great idea, but needs a few years to either scope it out, do R&D, whatever it is, in order to get to revenues. And our group we're really looking for companies that are just about to hitting the revenue spike. And so, we would define this as there's no product market fit yet. It might be a good idea, but it's hard for us to judge. Once you have a product in the marketplace, we know that, in fact, you've got customers, which means they're paying for your products. So we can get an idea of the price points that you can charge. We can survey them to find out what they like about the product or not. So there's lots of stuff you can do there. I am, of course, speaking about our angel network, and we get 50 applications a month for funding, and we choose 3 to present to our groups. So now individuals might invest, knowing that if they put a small amount of money in today, they can help you and influence you so that 3 years from now you can come to the angel group. So that's often how it kind of works out. So, the other way to think about this is sometimes what happens is, you've come up with an idea that really generates revenues 3 or 4 years from now, but is there a slight twist on the idea that could generate revenue today? So maybe you're developing a music software platform or something, I don't know, that's somewhere down the road, but can you release a version of that today, just to try and start pulling in your customers, to get some kind of revenue, to show relationships? I mean, it'd be something if you could say we went from 0 to 1,000 customers and then 10,000 customers, and even though they're only paying us $1 a month, we know the relationship there and we can figure out quite a bit about them. So I would look at the strategy. Now, a similar situation might be, it's not you, it's your capital structure. And, where I see this is a first-time fund entrepreneur that comes out and says, I'm raising $2 million. I need $2 million because my revenues, that's going to carry me until I generate revenues 4 years from now. I would say that that's just too much money. You should be, small increments. You basically start with your own money, which might be, I don't know, $10,000, $20,000. Then you go to friends and family. That might be another 100 or 200,000. Then you raise maybe 500,000. Then you raise maybe $1 million. Then it comes to the 2 million level. And there's if you raise too much money, you're going to be diluted. You're not going to own as much of the company as you should over time. And also there's the risk that you're going to blow through all that money and need to raise more. And, what have you got to show for it? So we see these things as risks, as, are you going to be applying money in the right areas? So it's always great if you have a small amount of money that you can put in and get some results, and then go from there. So can you scale back your plans? Do you really need to raise that $2 million? Can you get away with 500,000 this year and $1 million next year? Can you use any kind of cash flow, i.e. you introduce a product to market and try and get some kind of money in the door? So you're looking to figure out how you can, how dilution can be avoided any way possible. It's not you, it's your idea. So maybe your idea we don't get it. And when I think of imagine the first investment pitches from Facebook, right? He didn't actually sit down and say, guys, we're going to build a platform that I'm going to charge advertising dollars on, and all our clients are going to put up all the content for us, and we're going to all share private information back and forth. That's not what he said. He started out as, isn't this cool? You're going to swipe right or swipe left based on a picture of somebody. And so maybe investors just don't get the idea at first. And so, or maybe they get the idea and you're just not unique enough. Something we look for, knowing that it might take 10 years to get results back, we've got to make sure you've got some kind of defendable competitive advantage. So your idea is a good idea that you can somehow defend yourself. Now, maybe that's that you've got a patent, or maybe it's just going to be a marketing advantage that because you've got so many clients and you know them so well, you're going to be able to stay ahead, or you've got a better idea than someone else. Maybe it's also we didn't like your idea because it's a good idea and there's a market opportunity, but the margins are way too slim. I saw a pitch about 6 months ago, and it was for a ventilator. So, geez, with COVID coming, you'd think that we need lots of ventilators. And their concept was we're going to use off-the-shelf parts to create a ventilator. And their gross margins were going to be 9%, which means they're not really going to make any money in the grand scheme of things. And so, if we're investing to make money and you've got very, very slim margins, that's very risky. And so it's not good enough for us. So coming back to the first concept of maybe we just don't get it. Can you describe what you're doing better? Can you educate us on the idea? It's always great if you can pitch to a few individuals first to get and listen closely to the question and review that for your next pitch, so that you have a good understanding of what where people understand what your concept is and where the gaps are that they don't understand. When I was an analyst and writing research reports, I used to take my report and I grab one of the salesmen and go off in a side meeting and do the pitch to the salesperson and listen to what the questions were, because they would be reflective of what the portfolio managers would be asking the analyst, or sorry, the salesperson. So then if I can address that in a write-up, then that's going to help everybody understand the business more. So the same thing as an entrepreneur, if you could pitch to your friends or whatever and listen closely to the questions. When you go into any of these meetings, you should anticipate that there's a standard set of questions, and you should kind of be prepared with three, whether it's 3 elements for every type of question. Not that you have to give them all, but just be prepared. You're going to get questions. The other thing is, can you leverage your partners for growth? So as you're building the idea, and if you've got low margins, maybe it's a distribution channel issue. Maybe there's a way to leverage partners where you're developing something unique, whether it's that you have a new speaker or whatever, but maybe your partners can help you introduce a product in the market to get revenues in the short run in order to, generate some kind of cash flow to help you for the long term. So think about your partners and how they're going to help you grow. It's not you, it's your distribution strategy. I've seen this a number of times with the with the med tech space. Selling to hospitals is quite a challenge. And, sometimes we'll see entrepreneurs say they're going to build their own sales channel, their own salespeople to go and make the calls individually. And, that's just going to take too much time and too much effort. That there are well-proven distribution companies out there. You have the issue that they might be selling many other products, and so you'll have to get their attention. But, it's a well-worn strategy to go through distribution channel partners in the med tech space. So, you might want to think about that as an alternate strategy as to distribution, if that's what the issue is. And then, you know what, you're a great individual. It's not you, it's your valuation. So is it that your valuation maybe is too high today? I spoke about this earlier, is that, we need to make, the problem you run into with angel investing is that you scan a whole bunch of ideas, you come down to maybe your favorite 10, and you think they're all going to be really big winners. And they might have unique IP and fantastic products, but it's a tough battle for a company to survive 10 years when they have new competition coming in. You've got capital issues to deal with along the way, distribution issues. And so you really don't know which one is going to be successful. And so you really need it that if I invest $25,000 or $100,000 in this company, I need it to be $100 million company, because chances are half of them are going out of business anyways, and I need to make up for it. So in order for me to make a return, we had a company last week that was suggesting that we would invest and get a 20% discount based on whatever the next round of financing was. And the plan was the company hoped to never have to raise any more money until it sold itself, which means all he was offering was a 20% return on money to the next transaction. Well, that could be 7 years from now. So if I get 20% over 7 years, that's about a 2% return per year. I can't invest in that. I need valuations that are going to do really well. So what I have noticed is angels generally won't invest in a company with more than 10 million market cap. And if you look at the published numbers from NACO, which is the National Angel Capital Association, they show that the average investment valuation is somewhere between about $4 and $6 million, basically. So that's really where we're targeting. New ideas that are just hitting revenues that have a valuation in and around the $5 million range. And then we know that, you're going to raise money probably at 15 million and maybe 30 million or something like that. So the question is, have you valued it properly? And there's various ways to value companies. Are you sure that the investors, have you thought about whether the investors are actually going to make money in your venture? Does it make sense to them? Yes, you're putting a lot of sweat equity in yourself. And yes, it's hard work. But, have you made sure that there's a return for your investors? And are your terms realistic, right? Is it reasonable that, when we go back to that ventilator company, they wanted 27 million valuation for a company that was using off-the-shelf products that had no margin, and they wanted a 27 million valuation. It just wasn't realistic. So I can think of 2 more reasons. I think I covered 7 now. So I'd just like to quickly review, and this is the fun part because I got to design this. So hopefully you'll like this. Okay, reasons I didn't get funded. Number 9, say along with me. It's because the opportunity is too small. Number 8, don't like the industry. Number 7, revenues too far out, no product market fit. I can't hear you. You're supposed to be yelling along with me like on on Family Feud. Too much capital is needed. Right.
Too much capital needed.
There, thank you. Okay, here we go.
We're trying here.
We don't get it. You're not unique.
You're not unique.
Wrong distribution strategy. And the last one I just covered was, we can't make enough money with you, right? So there's 2 more and that I can think of. There might be others, I'm sure, but sometimes there's just distractions, whether it's the business cycle, whether it's COVID, whether it's a war or something like that. I mean, the guys that were launching companies last April, as we all went into lockdown and COVID, like there weren't a lot of investors at that point in time. So with those situations, you've just got to kind of hunker down, make sure you're not spending a lot of your resources, and kind of wait it out. And it might take 6 months or longer, but wait it out and come back and try and adapt to the environment, adapt to what's going on and survive. You should realize that when you're raising money, it's not a 3-month process. For a private equity, early stage company, it could take 9 to 18 months to raise money. So you should be kind of always raising money, but also recognizing and having your resources so that you have that runway to be able to raise money. And the last reason that I can think of is it's not you, it's, well, actually, maybe it is you, right? Maybe it is the way you communicate. Maybe you're just not very transparent. And, I've seen people be coy and they're not really forthcoming with answers, or they deflect. You ask a question and they're like, oh, we'll deal with that later. That's a big red flag to us, because if I'm investing in you, you're a stranger, I'm a stranger, I want to know that you're going to be straightforward with me on answers. Because the one thing is, I'm probably asking the questions to try and figure out if I can help. And if I don't know that there are always going to be issues, and if I don't know what the actual issues are, then that's going to frustrate me. And if you get into an issue, that often means that you then need to raise more capital. And if you haven't been transparent with me, I don't trust you, you're probably not going to get me to pull my wallet out a second time. And that's a big problem. You really have to think about the fact that with every check that you get from someone, it's not necessarily their first check. They're probably going to have other money behind it. And a successful entrepreneur kind of builds the number of people that are investing over time. And, this is not a quick, come in, smack up the marketplace, get as much money as you can and run off. You won't get repeat customers that way. So think of it that way. Maybe it's that you haven't done your homework and you're not giving the expected answers. You haven't thought about what the answers should be. So maybe you just needed to go back and You know, the worst thing you can do is if you don't have answers, you try and give what you think are right answers and they're not really. So you don't want to do that. And this all falls under the category of being coachable. You know, can we have a discussion with someone, make some suggestions, have them figure out whether it's appropriate for their business and come back and kind of improve that way. Now, aside from you, we're also investing in your team. And if it's a really early stage company, then, you know, the team is 3 or 5 people. So we know that if you're successful and you're going to grow and you're going to add to the team. But what we would like to see is that you're adding skills and improving the overall breadth and depth of the management team. You know, what I've seen so many times is, let's say it's an engineering type company, and all, you know, 7 of the 8 people are engineers, and the 8th person is the accountant. You sit there and say, okay, so who's your marketing guy? Who is it that's actually, you know, gonna bring that kind of aspect to it? Because we know that the best company doesn't always the best product or technology doesn't always survive. Often it's the marketing situation that survives the best. And then, you know, when you ask for a valuation that is unrealistic, you're conveying the fact that you don't really understand my point of view. And so that's not really conveying partnership. So that's something that you have to think about. So, you know, think about investors are partners. Communication is key. You want to build trust for an ongoing relationship. And I think that, so there were the reasons that I came up that I can think when I think back to all the companies that have presented. These are kind of the 9 buckets I would put them in. I'm sure there's probably other buckets, but that's what I think. I just put these on the end. I should talk about Angel One just for a second. This is the Angel Group. So this is what we've invested in. As I said, 86 companies. You know, so far since 2011, we've had 14 companies go out of business. And we've had 8 exits. So that's 22 total. So we still have 64 companies that are live and working. And within that group, there's some companies that aren't growing very fast at all. They're just kind of surviving. And there are other companies that are doing very well. So you get a mix.
And are they exiting to, like, are they going public? Are they going IPO? What's the?
Yes, sale acquisition is that's all I can think of. I can't think of any company that has gone public. You know, the world has changed a little bit in the go public scenario. Back in the 80s and 90s, that was definitely what companies were planning to do. The problem now is that there used to be many small funds that would invest in a company that went public, a small company that went public. The problem is those small funds have now all been consolidated. So the small funds are now big funds, which means, you know, their minimum investment might be $25 million. And because of the rules, they wouldn't want to be more than 2% of the exchangeable shares of a public company. Well, that means the public company's got to be like $1 billion in value. And so that's no longer a small company, that's a big company. So so then the route is not to go public, but to grow to a certain size and sell. As I say, we get about 50 requests a month, and three companies get to present. The average raise that a company coming through our network has asked for is about $700,000. The average amount of funds that if we invest, on average, we're putting in about $200,000. About 1 in 3 of the companies that present get funded. We're mostly looking for companies that have some revenues, that really they have a proven product, and we're just kind of fueling sales and marketing. There's much less on R&D. So they're in the process of expanding the marketing effort. And that's what I got for you. Just a little razzle dazzle at the end. So there's my contact information.
Amazing. Thank you so much, David.
I hope I anticipated every question, but then of course I hope I didn't anticipate every question so that you can ask anything you want.
So let's open up the floor to questions. I definitely have a list, but let's see if any of the other participants have anything.
Wonderful. Maybe why don't you kick one off, John, and then I'll get other people a chance to
All right.
get their notes.
So you mentioned that there are always going to be issues, as we know, and you also mentioned, all of these aspects that potentially aren't right and can go wrong later on as well. So is it that there's like a combination of these aspects that makes an investor want to invest, or is it just if you don't have all of them the way that we anticipate, there's no deal?
I think there are certain red flags that are deal killers. A trust would be one of those. That's just a deal killer. When about 2 years ago, we were looking at a company that was trying to help the brokerage real estate mortgage industry. And they had a big contract with one of the largest secondary mortgages. So they had a huge market opportunity, and they were developing a software platform to work with brokers that would sell this. And in doing due diligence, we started asking questions about their software process, of what they were building, where they were developing it. They were developing it overseas, what contracts they had in place with those overseas partners, because we were concerned about whether, this could be developed by someone else or copied by someone else. And then all of a sudden we've got a competitor in the marketplace. And, we asked these questions and they would not answer the questions. We said, don't worry, we know what we're doing. And then we'd come back, and it got to the point where they actually accused us, and we had hired a due diligence specialist, and they accused him of just focusing on one issue, and he keeps asking the same question. And does he really know what he's doing? Because he keeps asking the same question. And I had just joined at that time, so I kind of stepped in the middle of it and looked and went, maybe he's asking the question because you're not answering it. And they just weren't forthcoming with their answers. And eventually the angel said, I just can't invest here. And, those guys continued on, and you get to COVID, and, COVID, they're still developing their software. They're still making phone calls. People had slowed down buying housing for a little while, but the market picked back up. But all of a sudden they needed to raise more money, and there was no one willing to trust them, and they went out of business. And that's happened. So there are certain things that are deep red flags. But the assumption is that when you have a small company, it's never going to be perfect. And the purpose of the question is, one, you're trying to get a feeling for the entrepreneur and how they answer the questions. And two, you're trying to figure out if I can help. I've got a lot of connections that I have. So if I understand that you have a distribution channel issue, maybe I know someone in the pharmaceutical industry that could be of help to you, that maybe you'll hire, or maybe they'll introduce you to someone that you'll hire, or maybe you won't hire, you just make a contract. I don't know, right? So it's, if I'm investing my money, I want it to perform well. I want to be able to be of assistance. So I would say that with every company, there's going to be some issues there, but some things are fixable. And that's usually around the product, around the distribution channel and the idea. And that when it comes to the people, that's not really fixable.
Yeah, it doesn't really start the relationship off right if you're second guessing one another and not being transparent and forthcoming, right?
Yes, absolutely. And that can show up in many different ways. I recently had a company that I had invested in, and they didn't give us regular financial updates. And eventually we'd get our annual newsletter, but it was always late. And I have another company that I've invested in that like not quite monthly, but almost that often. We get here's what we're working on, here's what our challenges are, here's what we're looking for. It's not necessarily tied to financials, but at the bottom it says, you have any questions, give me a call. So if that guy calls me up and says, hey, we're now looking for more money, chances are he's actually going to give me many months advance notice. Looks like we could be looking for more money. We'd love to talk to you if you get a chance. Think about it, right? The other guy who I never hear from until he says, oh, guess what? We just lost money and we need some money. It's like, not sure I'm going to back you.
Right.
So I have other questions.
Lisa
Anybody
looks
else feel free to, yeah, Lisa, were you able
She's
to?
I have
working on
other
a question.
questions.
Go ahead, please. Go ahead.
Well, just on that point, I was thinking that's, to me, smart money, right? That's a company seeing you more as a partner,
Yes.
right? This is what we're working on. This is what we need. That's them understanding that maybe you and the network have access to people they don't have, or have contributions to make.
I think private companies get used to the fact they don't have to show all their information to anybody. And if I start telling you about my problems, then that can get out into the world that, oh, I just lost my sales manager. So if I tell you I'm looking for a sales manager, and then you tell two people, and before you know it, my competition is telling my customers that I don't know how to make sales. That's where I think the average fear comes from. And it's really just a matter of, as far as I'm concerned, of managing who you're dealing with. And if somebody's invested in you, you should be fairly open. These are what our challenges are today. And, I read a great suggestion one time. It's not, here are my problems, boom, deal with them. It's more like, here's what I need help with. I'm looking for someone to strengthen my sales organization. Right? I'm looking for a chief developer who has knowledge with these aspects. Can you help me that way? And then you put it in those terms, and people are like, hey, I'm on LinkedIn. I'll get this guy to, talk to two guys and whatever. That's totally different.
Makes sense. So where are you finding most of your investment opportunities?
Angel One is part of a group called Equation Angels. So it's 4 other angel groups, and one in Waterloo, one in London, one in Windsor, and ourselves. So 4 total. And we have a platform. You go to Equation Angels, apply to pitch, and you can pitch there. So we get, as I say, on average about 50 a month, and they come in from all over the place. We generally don't fund anyone outside of Canada. We'll get requests from the US all the time, and even some from Europe. We're mostly Ontario. I mean, angels like to invest in a company that they can go and see the people and, meet and help. But we will invest in Maritimes or Vancouver or whatever. I've mentioned the industries we don't do. So generally, we do like software, and so many people like software because it's so scalable. If you get it right, the costs are low. And then from there, it's, business to business, business to consumer, med tech. Those are kind of the categories. And they're, they could be startups out of universities. They could be multiple, an entrepreneur or an individual that retired at 50 that now has a new idea in the same industry and wants to come back and do that. We've got one like that right now called Cheetah, which is in the telecom space, and they're ex-telco people that are kind of creating a new opportunity.
That makes sense. So it's not that you necessarily prefer to invest or the organization prefers to invest in companies that have a founder with some seasoned expertise. You could potentially be working with founders that are
25. Yep, absolutely. And so in those cases, like you're looking at, so what is the idea? Maybe it's a new space that they're going in, and their insight into the marketplace is very valuable. Now, you still, so usually what happens is you get an experienced financial person to be their CFO, right? So it's like, okay, there's ways to run that. There's ways to run a marketing strategy. There's ways to do. So what you want to do is build the team around, let's not experiment on how to market something or how to do your accounting. That's all proven. Now you just want the resources to leverage the entrepreneur.
So David, we have a question in the chat from Neelam.
Yeah.
Social enterprises have a solid component of impact alongside business. And at times when they are speaking to investors that aren't big on impact, they skip the impact side of their work. I feel like that's a major loss. As an investor, how would you like a social enterprise to talk about, sorry, I have to scroll and I lost it, to talk about their impact work when speaking to you or other investors?
So I think how I answer that without sounding too money grubby is that we are doing investing. Okay, so we are trying to make a return. Now, some of our angels are also philanthropists, and they will, they will donate their money to good ventures. Now, we just had last month we had a company called Tamia's Cause present to us. And this is a group where the woman was abducted into the sex trade. She was brought over from Europe. This is 20 years ago. And she has become an educator to first responders. And, here's how you should deal with people. This is how you can make an initial contact, because obviously somebody in the situation is not going to say, hey, pick me out of here. There's probably a reason that they're caught in there. And so you need to work with them. Now, so they've set it up as an education business that they provide seminars to first responders, and they pay so much. And so we are evaluating it from a business perspective, and think that if all it was we're all volunteering to get the word out, how long will that remain sustained? Whereas if you actually have a business that 500 people paid $1,000 to go to, and next year 1,000 people paid $1,000, and the next year 2,000 people, then you've got a sustainable business. So getting to this, social enterprises are good, but you've got to understand what the end game is. And, is it Facebook? Is Facebook a social enterprise that started out for free with swiping of pictures that ended up being, this is an advertising business? Is it, so what are you doing? And it is good to be clear on all the different things you're trying to do. Because if you're not clear on it, what that's saying is, you're going to raise money because you're doing these certain things. And then, now that I have the money, I'm also going to do these things. Well, do you actually have the resources to do 6 things when you only raised money for 3 things? So that's the trouble it can get you into, is if you're not open and honest, then, are you using up resources that we're not aware of, and therefore the investment we're not going to be supportive of. Again, coming back to the transparency and trust, tell us what you're working on, because maybe we can help. And, but, let's figure out, is it a not-for-profit investment or is it a for-profit investment? If it's a not-for-profit, then, maybe that's not a good angel investment. Great question.
Bit of a follow-up to that. Do you see a trend towards impact in the investment field? Like, for example, towards clean tech versus oil and gas? Is that trend pervasive towards all industries, or is there like little pockets here or there?
So remember, as an angel group, we're individuals. So if there's 30 people in the room, everybody's got their own thing. Everyone is becoming more aware of social issues and carbon neutral positioning. As I mentioned, we don't do resources, but I can imagine that if we do look at, hey, I've got a new solar powered water heater product, and then we'll evaluate them, and we'll evaluate them as though it's a business. Do you have IP? What's your distribution strategy? What's your margins? What's your valuation? How are you, what's the demand for this? If everyone already has, electric water heaters, well, okay, there's savings. It costs, if I save $100 a year on hot water heaters, which wouldn't be the case, it would be a much higher number. But if I save $100, but it costs me $2,000, then, the cost benefit doesn't work. So it's got to be a business. But, people are interested in those directions. We're conscious of, how many female leaders we have and how many visible minorities. In trying to judge that and be conscious of that, it's often difficult how to evaluate it. But it is top of mind to us, but no one says we need a woman in order to make our next investment, or, we need a non-white guy. But it is something that you look at, and I've tried to actually document of all the presenters, what kind of categories they fit into. But then, I don't really know if someone is named Joe Simpson, and they're an immigrant from the Philippines. Like what does that mean? What does that mean? Right? But we are trying to observe it and give all sorts of people a chance, because ideas come from everywhere. So I guess coming back to the question, there's 30 people in a room. These issues are top of mind of ours, but we are looking for investment opportunities. There's still a lot of oil being bought and sold. I mean, anyone who drives their car knows that they got to buy gas. But, we're not, a long time ago, we gave up the looking at tobacco industries. And right now our group doesn't do cannabis. So just not where we're interested.
Anybody else have any questions? I don't want to monopolize the time with my expansive list.
Hey, David, thank you so much for your presentation. I have a question on, this might be like a tangent, but if one angel group doesn't invest, how do you find other ones?
So there are something like 14 or 17 provincially sponsored angel groups. And the province, in fact, has stopped sponsoring us. So Angel Investors Ontario lists all the members. Now, Angels Investors Ontario had some financial difficulties recently because the province has stopped funding them. So I don't even know if the website is still up. You could do a Google search, but there's Northern Ontario Angels, there's Maple Leaf Angels is downtown Toronto, there's York Angels, York Angels is in the Markham region, Spark Angels I think is the Peterborough region. As I mentioned, there's us, and GTAN is the Waterloo group, SWO is London, WeCan is Windsor, NAN, which is the Niagara region, GAN is the Georgian region, so that's Barrie. That's pretty much the list, and then from that there'll be private angel groups. I've mentioned NACO. So NACO Canada, although I think their website is builtbyangels.com because they have a new website. NACO Canada is the National Association of Angel Investors, and they will also list many of their members. So you'll get angel groups. There's one for healthcare specifically, and that's Halo Angels. So do a Google. If you were traveling to Austin, Texas, I would do a Google search for Austin, Texas Angel Group and see what comes up, because it'll probably show you one. There's groups all around.
Thank you for that. Yeah. And do you recommend submitting to all these angel groups at the same time to artificially manufacture some competition?
So you do want to talk to multiple groups. The one issue you run into is that if you go to everybody at once and you do one pitch to everyone at once, and if there's something in your pitch that should have been corrected, then you kind of blow your chance. So if I were you, I would start with one group and figure out the feedback, and then from there you want to go to the other groups. What I would also say is that what you really want is you really want to use an angel group to fill out your round. So let's say you're raising $1 million and you already have 750 from someone else. Then you go to the angel groups and you try to raise 250, and maybe you'll get 500, and instead of raising $1 million, you raise $1.25 million, and you get the angels. Because what will have happened in that scenario is you will have already determined your valuation by whoever that lead investor is. And then now you're going to the angels saying, here's my valuation. We're going to close with these guys. And chances are those investors are helping you build your business. And then you tuck in the angels at the end. If your first meeting is with the angels, then they're going to drive the valuation, and you're going to be going to everybody else with their valuation. And that might be fine. That might be fine, but you have less control over it. The one thing is the way Equation Angels is working, that Angel One is part of this group of 4, is when you present to us, you're presenting to 4 groups all at once. So if it works, great. If it doesn't, you probably need another year before you can come back and present to us. Prior to COVID, we used to do individual meetings, and we would take companies on a roadshow. So they would come to Angel One in Burlington and present, and then they'd go to Waterloo that evening, and then they'd go to London for breakfast the next day and Windsor for lunch. And we, in fact, had a company that presented to us at Angel One, and it really was not a good presentation. I sat down with him after the presentation, and for an hour and a half, we reworked the presentation. He went up to Waterloo and got investors, went to London and got investors, and that really helped. Now that we're in COVID, it is one virtual meeting. Actually, this month, we're going to have 2 separate meetings, but for the past year, we've had one virtual meeting each month, which means if you present to that one group and everybody's there, and if it doesn't work, you've blown all your contacts. So I would suggest going to one group. If you can get outside investors first, do that. Then you're bringing in the angel group. I would approach one of the angel groups where you have some contacts, and then expand out to the other ones. We do talk amongst ourselves, not only within the network, but across the networks. We usually have a monthly meeting with the other angel group executive directors talking about, oh, we saw this company, they're pretty good, you guys might want to take a look. So we share information.
That's great advice. Thank you so much. Best talk I've seen on this topic.
Thank you. Thank you. It's also good if you are a special industry. Try and figure out, like if you're healthcare, I'd be going to Halo Health. So see if there's any any industry specialty that will help you.
Yep, healthcare here. Yep. Okay.
Oh,
thank you so much.
Yeah, you're welcome. The other thing that made me think was, I believe the angel groups were originally established in conjunction with the incubators. So for instance, Angel One is with Haltech and Innovation Factory, and that GTAN was with Communitech. So that's the other way to find them, is the research innovation centers should be able to point you to the local angel group. Lisa used to organize road shows for the clients. It's 15 years ago. Nerve-wracking. Yeah, absolutely. Yep.
So I want to jump on a point that you made, David, about perhaps angels are good for slotting in those last good slots to fill up the round.
Yep.
Because then the angels don't get to kind of dictate the valuation, is what you said.
Yes.
So there's often a bit of frustration when there's that incongruency between the founders and the investors who don't see eye to eye on what that valuation is.
Yep.
So how can an entrepreneur reconcile that kind of discrepancy between the progress that they think they've made and their ultimate valuation and what the investors are thinking?
Yeah, so is recognizing a bunch of aspects. So one is there actually is a Goldilocks valuation range that if your valuation is too low, I as an investor actually, it doesn't work for me because, and what I mean by that is if we drive down the valuation so low that on future rounds, you as the entrepreneur are not going to own very much of the company, then I'm at risk because you're the knowledge base. If on the next round you only own 10% of the company, you might say, I'm out of here. I'm not getting wealthy enough. So in fact, I don't really want to drive you so low that you don't get a good return. And on the same end, too high a valuation, I don't get a big enough return. So that's the first piece of the puzzle that says, there should be an area to reach. The second thing to recognize is that we all have dreams and we all hope to have billion-dollar companies, but the reality is most Canadian companies get bought out, and even North American companies get bought out in the $30 to $40 million range, not the $100 million range. It's very rare. So in fact, we're evaluating, from whatever value is today, if it's $10 million, chances are you're going to sell at 30 to 40 million. So the most I can hope to get is a 3 times return. And then when you start bringing in things like ESOPs, so employee share ownership plans, that's extra dilution that impacts me. So in fact, where I think I'm going to get, if it's a 6 to 10 times return, if you start putting in ESOPs in that, I actually end up getting like a 4 to 6 times return instead of 6 to 10. Or in other words, it actually reduces my return by about 40%. The next piece of the puzzle is it usually takes twice as much money and twice as long as you think. And in both those cases, that reduces my return on investment. Because if you think it's going to be 5 years, maybe it's 10 years. If you think it's just going to take another $5 million and maybe it takes 10 million, that's dilution to me. So, I don't mean to under encourage an entrepreneur. You're excited about it, you're going to make money, and that's great. But recognize that there's a whole lot of issues you're going to have to deal with, and you need my support. I can tell you that, we had a company that recently exited a success, and it was very interesting to see. They did about 6 rounds of financings and the buyout. And the people that invested in the first 4 rounds was on a normal valuation, and they put the money in, and it went up, next, okay? And then the company got into financial difficulty, and they had to finance at a suppressed valuation. And then the company was successfully bought out. For anyone that participated in the first 4 rounds and didn't participate in the down round, they made a 6% return ROI. For anyone that participated in all, they made a 12% return. And for the guy that only invested in the down round, he made 800%, 8 times his money. So if you're a smart investor, that's where you're going to make money. He came in when there was big risk, but big reward, and he could somehow evaluate it, and it worked out. So there's a successful situation where they hit a wall, and the people who said, "Oh, I'm not going in," they only made 6% over time. So you've got all that going on. Then now, how do you value companies? And you look at NACO and comparable analysis, and it says that most early stage companies with just a small amount of revenues are valued in the $5 million range. Now, maybe you're special, maybe you're worth more, but I know I've seen it many times. Great ideas, products ready to go to market. Company says they're worth 15 million, and people just put their pens down. Just like, okay, good luck. See you later. It's just, not going to be worth the return, because if you're successful, it goes from 15 to 40 plus dilution. I've only, barely doubled my money. If you're unsuccessful, I'm obviously not making a return. So I need that venture to be down somewhere around the $5 million range. Maybe it, it depends on how early stage, whether it's really 3 or whatever, in order to actually make some money along the way. Right.
And it's too risky to tell, if they're saying that they're at 15 million valuation,
Yep.
then perhaps they're claiming they're going to go above that 30 to 40 million exit that we generally see, which is perhaps a huge statement to make at an early stage, right?
Well, and that's the discrepancy that ends up needing to be discussed. Is you're excited, you're the entrepreneur, you think you're worth 15 million and you're going to sell for 100 million and get out of my way. Lots of people told me I couldn't get this far and I got this far. And then we sit back and we say, yeah, but the reality is you're one in a million is going to get there. So we can't really invest based on that. There's a number of angel groups in the US that have published their portfolios, and it's fascinating to see. There's a group that is called Tech Coast Angels, and they're a California group. So imagine if you could have been in a California angel group in the 2000s timeframe and how successful you would have been. And they published their portfolio and said that they had, from 1997 on, for 20 years, they had 117 investments. And 25% of their investments went to zero. 25%, they lost on average half their money. So these are super smart guys making big bets, thinking this billion-dollar opportunities. And on 50% of their investments, they lost money. It worked out that 3 of the portfolio ended up with something like a 30 times return. And as a result of that and the whole mix, on average, they made 5 times their money. So they put in 10 million. And after all these companies were done, they had $51 million. But why wouldn't you just invest in the best 3? Because you don't know which ones they are. And that's the challenge. So that's why it comes back to, okay, you look like you're special. But you're going to have IP challenges. You're going to have competitive challenges. You're going to have to hire a whole bunch of people that aren't going to go to Microsoft. You're going to have to, get distribution agreements, deal with the governments, all COVID, all sorts of stuff along the way. And there's risks that, you just have to understand that we've dealt with many, many times, and you need to understand that. So that's why it's got to be reasonable, right? You got a product developed, I know it's not going to be $1 million valuation. So getting back to, so shouldn't angels value it appropriately? If you can leverage an industrial partner, so you have a solution to the insurance industry and Manulife says they're going to invest, or to the oil industry and Enbridge is going to invest. Well, that gives you a leg up. But don't think you're worth 15 million because of it. But that might help you set the valuation at 7 million, maybe. And then now you can bring in the angels behind that.
Anybody have any questions before I follow up with mine? Well, feel free to type in a chat, and people feel free to also talk a little bit about what you're doing, and perhaps ask David some more specific questions to your situation as well. For the time being, I want to ask about the early stage entrepreneurs. Like, is there even any value for an early stage entrepreneur to approach an angel investor if they're not at that $5 million valuation, or perhaps don't have the evidence to support that? And if there is value to speaking with an angel, then what's the best way to make the most out of that conversation?
Yeah, so a few answers to that. So knowing that the path is really, your own sweat equity and friends and family, it's through that you get talking to friends of friends. And that's probably where you hear, like, what's an angel? An angel is a stranger with money, really, right? Now it's nice if you're connected with an angel group. So our meetings are for what's called accredited investors. So that's a category that the OSC has deemed that you're legally allowed to invest in a private equity firm if you know, you've made at least $200,000 in the last few years. You've got investable assets of at least $1 million. You've got 5 million of overall wealth at least. And so our meetings have accredited investors at them. You can ask to come and can I observe one of these meetings? So you can kind of see what's going on. We do that. Otherwise, I'm not sure how you meet them. I suppose if you evaluated your business and you could think of channel partners or other people in the industry, you know, you could knock on a door. Like if you're a med tech device, then, you know, maybe I would go to the regional innovation centers and see if you could get an introduction to someone in the field. And that's where you're going to maybe get somebody to say, okay, I'll give you $25,000 to get going. And then from there, it's their relationship that helps you get in the door to the network group. I guess, you know, it's challenging to find money. There's no one path. Certainly the regional innovation centers are a great help. They've got people that provide you their, they might even be a volunteer. I've been a volunteer for the last couple of years at Haltech. I became an entrepreneur in residence in the fall, which just means I'm paid by the province for the time. You know, there are people around. I would probably start there and say, are there any mentors that can help that are interested in the field?
All right. I guess I'll open up the floor again. Catherine, Gary, Sean, Matthew, haven't heard from you. Daniel as well. Do you have any specific questions?
There's no bad questions. It's okay. You're listening in. All fair.
All right. Well,
I have a question. Did you like my Family Feud? Pa-ching, pa-ching. I forgot the bell. I was going to do the bell too. Pa-ching, as the slides changed.
that was awesome.
Okay. Thanks.
All right. Well, I guess if there aren't any further questions, I've exhausted my list. I think you've done a great job, David, at really describing the situation and providing lots of good insights. And something that I really picked up was what you said about the Goldilocks valuation. Yeah. I thought that was super key. So that was great. There are lots of other points as I'm looking at my notes that I think you really brought out and provided context to. So thank you so much for being here. I see that Tiana has posted something in the chat for the feedback form and also to check out our other upcoming events as well. And if there aren't any further questions, then perhaps we can give the time back and let everybody get on with your day.
Yes, please provide feedback to the feedback form so that, and I would love to hear it so that I can improve for next time. Mm-hmm. Terrific. Thanks, everyone.
Thank you, everybody, and enjoy the rest of your day. Oh, Tiana, would you like to close us off?
Sure. I was going to say thank you, everyone, for joining. In the chat, I put upcoming Edge events, feedback form, and also programs if anyone is interested in joining. But thank you, everyone, for joining. Thank you, David, for being our special guest today.
Pleasure. Nice speaking with you. Thanks.
Thank you.
Enjoy the rest of your day, everybody. Bye now.